today we're going to talk about, is the stock market in a bubble? I've heard a few people starting to whisper it. It's getting a little bit frothy out there. So today I thought, let's do a dedicated video on it. And just to confirm, we are talking about the US stock market. We are not talking about the UK stock market. The US stock market has been on fire this year. The UK stock market, I mean, that's destruction. We'll probably do a video on that actually tomorrow anyway. But yeah, let's get stuck onto today's video. So the stock market has been great for me this year so far. If you look at IMS and hers, this week alone is up 13%. You look at SoFi, up another 13% this week. You look at DraftKings, up 7% this week. All my stocks are doing really well, and I've had a fantastic year in the stock market this year. 2023 was good, 2024 was good, but the stock market is rallying pretty hard. And as you look at the S&P 500, as you look at the last 5 years, up 91%. This year, up 25%. And obviously, that's coming off a very strong 2023. We're starting to see valuations get a little bit extended. And a lot of people have been saying, is this near a top? Are we entering a bit of a bubble phase? And that's what we're going to focus on today. So when I look at the S&P 500, I am a little bit concerned. Now, the big thing that I think people struggle with is separating the S&P 500 and the stock market. The S&P 500 is not the stock market. So there's different things we have to look at here. The S&P 500 has done very well and is at stretched valuations. But I'd look at something like the Russell 2000 and I would say that this isn't, or the S&P 600 isn't as stretched valuations. And when we look at like a P ratio basis, as you can see here, it's currently 30 times earnings for the S&P 500. Now, historically, this has normally traded around about a 21 times earnings. So this is definitely higher than where we have been. It's definitely at a premium than where we have ever been at. And the only times that we have had a higher P ratio on the S&P 500 was the 2021 stock market crash, or 2022 stock market crash, depends what year you want to call it as. That was the last time we saw a big major crash in the stock market. The other time was the great financial crisis in 2009. And the other time it was that high was during the tech bubble. So the 3 times that we have had a P ratio this high have caused a stock market crash. So that would be an indication the S&P 500 is certainly in overvalued territory. Now, when you look at some of the smaller market caps, like the S&P 600, I look at the S&P 600 and go, they're actually not too bad valuations. You look at the S&P 600 at the moment, that's around about 14 times earnings. Historically, the S&P 600 has traded a lot higher than this. It's been 18 plus times earnings, as you can see here. And I would actually say that this is, pretty good value, and that's why I personally have been buying a lot of small caps here. Now, the last time, like I said, we had a stock market crash was in 2021, 2022. Some of you guys would have gone through that stock market crash as you would have been watching the YouTube channel. I was here covering it nearly every day on the YouTube channel. Some of you guys that may be new to the stock market, 2023 investors, 2024 investors, you haven't really gone through a crash yet. But some of you guys on here, you'd have followed me through the 2021 crash, and you'd probably followed me through the COVID crash as well. Some of you might have been through the 2018 crash, which you can't actually see on here, but that wasn't as bad as the other crashes here. And, some of you guys might have been remembering that time, and that was definitely a bubble. That was where everything just went up. You miss earnings, doesn't matter, it goes up. You're losing more money than your market cap, doesn't matter, it goes up. You have no revenue, doesn't matter, it went up. That was a time frame where a lot of things just went up, whatever happened. And that did affect the stock market. And if we do zoom out on like the S&P 500, you can see here when we kind of peaked in the S&P 500 around 2021 time, it was a bit of a wipeout. It took nearly a good kind of 2 years-ish to kind of recover most of that dip that happened during that time frame. And you had 2 years of really the stock market not really doing anything, unless you were buying during that lows, which I was doing, and a lot of you guys were doing, and obviously you made really good money from it. But a lot of people that bought during this time frame, had to wait 2 years to kind of get back positive on it. But when I looked at the S&P 600, I never thought and this is probably one of the mistakes that I made in the last stock market crash of 2021, 2022. I was actually looking at the S&P 600 and the small caps, and it did go a little bit higher than what it normally did do. It went from about 17, 18 times earnings up to 20 times earnings, and or 21 times earnings, and it went a little bit higher than what it normally did. But I was kind of looking at that going, it's not that bad. But actually, when you look at some of the small caps as well, to be fair, the small caps have only just recovered from the 2021 crash. It's nearly taken them guys 3 years to recover from that dip. Sometimes when you go, the S&P 500 is quite overvalued. I look at the S&P 600 and I never thought that was going to pull back like how it did do in the last crash. So maybe when we did maybe if the S&P 500 was to pull back, it would bring the whole market down with it. We just don't really know. But when I do look at some of the small caps, and some of the ones that I was buying, and like SoFi, and I've seen people going, oh, it's a bubble because SoFi is going up. I don't know, because I look at something like a SoFi, and even though it's trading at a bit of a richer valuation, 53 forward times earnings, you've got to remember the numbers that SoFi are currently doing. They're doing nearly 30% revenue growth and the profit is moving up massively in the right direction. And ultimately, when you look at that and you look at the numbers they're doing, well, SoFi is going to trade at a premium. You're not going to get a company that's growing 30% year over year at 20 times earnings. There's going to be a premium on that, and is 50 times forward earnings the fair premium? I would say that it wasn't too bad. I look at something like a Hims and Hers, and this company is currently 42 forward times earnings, and you look at the numbers that they're currently doing, and they're currently growing at 77% year over year, and the profit is ramping up massively. And I look at the rally that Hims and Hers has been on, and people say, well, is Hims and Hers in a bubble? And I would say that I don't think Hims and Hers is in a bubble stage, because when you look at Hims and Hers, even though it's up 150% year to date, it's still not a bad valuation. 42 times earnings for a company growing at 77% year over year is pretty fair when you look at it. Same again, 20 times earnings, you're expecting a company that's growing 3-4% a year. So when you get a company like Hims and Hers growing at 7% year over year, it's going to be more of a premium. It's growing 20 times the normal growth rate of a normal valuation company. When you look at Hims and Hers and you start running the numbers, very quickly, if you grow at 77% a year over year for the next 5 years, that's going to look very cheap at 45 forward times earnings. So there's an element where, in my opinion, some of the small caps have rallied up, but they've rallied up because they were ridiculously cheap. Because when we go back to the last stock market crash, when it put a lot of these stocks down at like $9, Hims and Hers was $9, well, we even saw it go to $3, when we saw the likes of SoFi go back down to like $5, whatever it was. The reason why a lot of these have rallied, because they got punished, even though they didn't actually have that bad valuations. When you looked at like the S&P 600 valuations, it wasn't actually that bad, but they got all dragged down because the S&P last time went to ridiculous valuations. But what I'm looking at the moment right now, and when I look at the worrying signs and I look at the P ratio on the S&P once again starting to get a little bit stretched, I'm starting to see the things like Bitcoin. I think Bitcoin's a great indicator of where the greed is in the market. And as we saw last time, when Bitcoin went absolutely ballistic, up nearly 400%, is when we saw the top of the market. And that time frame when the stock market pulled back and Bitcoin pulled back, and it was down 63%. Now, if you look at Bitcoin once again, what's Bitcoin rallied again? It's nearly rallied up 300% since that time frame. So you have Bitcoin nearly rallying up the same as what it did last time, in basically a straight up rocket ship. Right now we're going up in a straight up rocket ship. And I think that's a sign of like, okay, it's getting a little bit frothy. I think Bitcoin is a measurement of how frothy the market is. And I'm not a big fan of Bitcoin. I always say, like, I personally only invest in things that I can value. I can't value Bitcoin. When you look into value Bitcoin at the end of the day, you're looking at that and thinking, your hope is that it's used more. And I don't know if it's used more. I don't buy a product and I go, I hope DraftKings is used more. Why is the reason that DraftKings will be used more? Well, it's going to come online in more states. Right, so there's a catalyst for it. Bitcoin, you're just hoping it's used more. That's all it is, and that's really hard to evaluate. You look at DraftKings when you go, oh, but the states are going to come online, and if they do what they do in New York and they do that in California, you can start working out the numbers. I get the valuation from it. You just don't get that with Bitcoin. And somebody actually posted on the Discord the other day, and I should have quoted this, and I apologize for whoever posted it. But they said, like, they went in to go get a haircut at the barber's, and the barber was talking about Bitcoin price. Or someone in the barber shop was talking about Bitcoin prices. And that is exactly it. When those conversations start happening, when your gardener starts talking about Bitcoin to you, that's the sign that it's getting a little bit worrying. And that's exactly what's kind of going on right now, when you have them kinds of worrying signs. And it kind of goes back to, I don't know if you've ever seen the book or read the book, One Up on Wall Street by Peter Lynch. If you've never read that book, go read it. In my opinion, the best investing book out there. One Up on Wall Street by Peter Lynch, and he talks about the cocktail party. When everybody's talking about stocks and you go to a cocktail party, then you get a worrying sign that the market is getting a little bit frothy out there. We may be near the top. when you go to a cocktail party and nobody wants to talk about stocks, you're probably near the bottom. And right now, everyone's talking about Bitcoins at the moment, and that's a sign that maybe we're near the top. You go into a party and nobody wants to talk about Bitcoin. Oh, I bought Bitcoin, and when you look at 2022, for example, and all the people who bought, getting all that hype in 2021, and the stock fell, Bitcoin fell 68%. Not supposed to be linked to the economy, but clearly moves, or the stock market, but clearly moves where the stock market's going. And you look at the fall off in Bitcoin during that time frame. You'd start talking about Bitcoin in 2022 to someone, they don't want to talk about it. I invested in Bitcoin, I'm down 68%. So that's another example, in my opinion, about where the kind of market's at. And then I look kind of like the popular retail stocks, and that's when I look at the likes of Tesla, for example. Tesla has had a really good year. Up 36% year to date at the moment. And you look at the market cap on Tesla, and the market cap of Tesla has basically gone from August time of around about 500 million-ish, 500 billion-ish, and it's gone up to like nearly 867 billion. It's had like 360 billion of market cap added onto it. It's nearly doubled up on a market cap basis from where it was in 2 months ago. Now you've got to ask yourself, when you have stocks that start adding 350 billion to the market cap within a 2-month period because of a US election, because Elon Musk is now really good friends with whoever the politicians are in charge, does that deserve to add 350 billion to a market cap? When you start looking at Tesla's numbers, and it's 137 times forward earnings for a company growing at 7%, and you've had 350 billion market cap added onto a company just because someone's a friend with who's just been elected as the president. And you start seeing those kind of posts where you see people posting, and I posted this on a video not too long ago, and I'm part of a Trading 212 group on Facebook, and I saw people like this, posting saying, I'm new to stocks, I recently bought Tesla, say around 3 weeks ago, and then I'm up, shall I continue buying, or what shall I do with my stocks? When you have them sort of people like chasing the stocks like this, that's when it gets a little bit worrying. When you start looking at stocks like Palantir, for example, I think Palantir is a good stock. This is not me having a dig at Palantir. This is not me having a dig at Tesla. I'm just talking about the momentum and the valuations that they're at. And you start looking at Palantir, 310 times earnings. Even on a forward P ratio, this is 162 times earnings. And this company's growing 30% year over year. I mean, it's a great company. It's a premium company. It's going to trade at premium value. We just talked about SoFi and Hims and Hers. They're premium companies, guys. They have very similar growth to Palantir. But when we talk about SoFi's run, but yet they're only still down at whatever it was, 58 forward times earnings, and you start looking at Hims and Hers stock, and Hims and Hers is like 42 times forward earnings. When you start talking about a company that is 4 times the forward P than these companies, but yet they have the same growth rate. Once again, it's another example of maybe it's getting a little bit frothy out there. When we started to see this sort of thing happen last time where valuations just didn't matter, it was 2021. And as we saw in 2021, when the correction did happen, it only takes a little bit. You imagine one little negative news story comes out, boom. These valuations are going to snap back, and the more they get stretched, it's like an elastic band. The more it gets stretched, the bigger the pullback, which hurts even more. And it would only take sometimes, a 10% drop on some of these, and you see the panic come in. I remember in 2021 stock market crash, that 10% drop, just that 10% drop sneaks in, and the damage that it's causing to the stock market, the panic takes over so fast. And people don't realize this. If you haven't been through the 2021-22 stock market crash, if you're a new investor, you don't really realize, and this isn't a dig, but you don't realize like how fast fear takes over. You guys that went through the stock market crash, you would have seen how fast fear takes over. If you went through the COVID crash, you would have seen how fast fear takes over. When fear comes, you talk about a rocket ship going up. I tell you what, you want to see how fast it comes down. It's like a broken lift that's falling through the floors. It is awful. As soon as fear takes over, you will see stocks absolutely snap back massively. You're talking the likes of Palantir, Tesla, they'll be giving 7% back a day. It'd be down 35% in a week. That's what happens in a really fearful market. And the more the valuations get stretched and we do hit any sort of fear, the faster you see that happen. So I've talked about this, and hopefully you kind of get my feeling here that I think that there's certain stocks overvalued, and there's definitely some bubble, bit of a frothy market coming in. At the same time, I think some stocks are actually okay valued and they justify the runs that they've been on. But like I said last time, when I did this is that I thought, okay, you know, when we were in 2021, 22, I thought, okay, a lot of the big market cap stocks are overvalued. Some of the small caps aren't bad value. But as soon as the big ones started falling, they all fell. So even though I think that some areas are undervalued, but some, you know, areas are overvalued, it only takes some of them to tumble to bring everything down. So you never know. So I'm just going to finish off with, like, you know, what's my kind of thoughts and what's my kind of plan of action here. Well, first of all, I don't time the market. I think most of you guys are aware. I don't time the market. I just dollar cost average and I buy stocks whatever the valuation. Whatever the valuation, but if I see a stock that's a good valuation, it won't stop me buying it just because I think the whole quite a few of the stocks, you know, are overvalued. I'll still keep buying stocks at good value. There's certainly times where if everything's undervalued, I'm a lot more aggressive buying, like 2022. But there's also a time where there's not as much value out there, and I think that's a period that we're in, and I slow down my buying. So there's times where I speed up my buying and slow down my buying, and right now I'm going through a slower buying patch, but I'm not stopping buying. I'm still buying, I'm just slowing down the buys. And also that if I do believe that we are maybe seeing opportunities sometime soon, that also means I build up a bit of a cash pile, and that's certainly what I'm doing, is that I'm still buying. I never time the market, because you never know. You know, from here, the stock market still might rally. Even though we're at rich valuations, the stock market still might rally up another 20%. And then you'll be thinking, yeah, we're crazy overvalued, but hey, at least I'm making a lot of money right now, and you might be trimming some of the stocks on the way and you're making, you know, really good amounts of money. You know, you don't want to miss that out. But at the same time, you've also got to be prepared for the worst, you know, what could happen if a really bad situation came up in the stock market. So you've got to kind of play both ways, but my feeling is that we are in a more of a market that I think is a little bit more frothy, and I am a little bit more cautious, and I am building that cash pile, and I am slowing my buys down, but it's not going to stop me buying. I'm still going to continue to buy where I see the opportunities, but I'm a lot more cautious. I'm not, you know, I'm compared to like something like a 2022, you know, you guys that were in 2022 and went through the stock market crash when we had the stock market crash in 2022, you know, you would have seen that I was just aggressive. I was just buying. Cash pile went down to 0%. I just bought everything in sight. I worked overtime at my job, my full-time job, to be able to buy more stocks, and that's the where I'm at, where I was at during that time frame. But I'm nowhere near that. I'm definitely not doing any overtime at the moment. So yeah, I'm definitely a little bit cautious about where we're at, but I don't dramatically change my investing plan because of where we are in the market. I come from being, there's times where I'm more aggressive, I'm more cautious. I'm certainly more cautious at the moment, but it doesn't stop changing my investing plan. But I definitely have a few concerns out there. Hope you enjoyed the video, guys. I'll see you on, I'm going to try to do a Saturday video and a Sunday video over the weekend as well, so keep an eye out for that one as well. But hit the like button, subscribe if you're new around here. I'll see you in a bit.